Assalamualaikum warahmatullahi wabarakatuh. Today my group will present about the interpret corporate financial statement and its limitation using analytical technique. This is our task 3, which is our final assignment for financial statement analysis subject. Okay, this is our table of contents that firstly financial statement analysis, liquidity ratio, asset management ratio, debt management ratio, market value ratio, and comparison analysis. This all will be present by my group and me. So, okay. Firstly, I will introduce myself. My name is Muhammad Zulzafran Hilmi bin Bahrain with ID card number PDA 1905033, and I am from DIA 6B. Okay, I will present about the financial statement analysis. Let's go to the first, which is a purpose of financial statement analysis. The general purpose of the financial statement is to provide information about the results of operation, financial position, and cash flow of an organization. This information is used by the readers of financial statements to make decisions regarding the allocation of resources. At a more refined level, there is a different purpose associated with each of the financial statement. Each of the financial statement has a different function at a more detailed level. The firstly is the income statement. The income statement tells the reader of a company's ability to make money depending on how cost data is aggregated. It also shows the amount of revenue and the essence of different forms of expenses. The income statement can be used to assess patterns in the performance of company activities when analyzed over several time periods. Secondly, the balance sheet. The balance sheet's aim is to notify the reader about the current state of the company as of the balance sheet's date. This data is used to measure an entity's liquidity, funding, and debt status, as well as to calculate the variety of liquidity ratio. Finally, the statement of cash flow is used to demonstrate the existence of cash receipt and disbursements in various categories. Since cash flow do not necessarily fit the revenue and expenditures shown on the income statement, this knowledge is extremely useful. As a group, the entire set of financial statement can also assign several additional purposes, which are firstly credit decision, which is lenders use the entire set of information in the financials to determine whether they should extend credit to a business or restrict the amount of credit already extended. Secondly, investment decision. Investors use the information to decide whether to invest and the price per share at which they want to invest. And acquirer to use the information to develop a price at which to offer to buy a business. Thirdly, taxation decision. Government entities may tax a business based on its assets or income and can derive this information from the financials. Lastly, union bargaining decisions. A union can base its bargaining positions on the perceived ability of a business to pay. This information can be gleaned from the financial statements. Furthermore, financial statement for particular subsidiaries or business divisions may be analyzed to ascertain their performance at a finer level of detail. In short, the financial statements have a number of purposes depending on who is reading the information and which financial statement are being produced. Okay, let's go to the tools of financial statement analysis. Financial statement contain vital relevant information that helps to assess the company's financial standing. Financial analysis use various tools and techniques to analyze this financial statement and bring out important information that helps in better decision making. It also helps to identify trends and patterns based on historical data. Let's delve deeper into some important tools and techniques used to analyze financial statement. As you can see here, the first tools of financial statement analysis, which is this is the major tools of financial statement analysis has been used, is comparative statements. So comparative statements are useful financial statement analysis tools that allow you to compare various elements of financial statements such as the profit and loss statement and balance sheets. It's used to compare the elements of two or more periods financial statements. So to compare the balance sheet and profit and loss statements, two separate comparative statements are prepared. Gross profit, operating profit, and net profit are the main elements that are compared in profit and loss statements. These parallels aid management in identifying problem areas and making appropriate changes. So, we go to the second tools of financial statement analysis, which is last in my presentation, common size statement. The common size statement tools take a vertical presentation approach to represent financial information. The interesting thing about common size statement is that it doesn't include the absolute value. Instead, it uses percentage form to depict the values. The determining factor or the value that is taken as 100% for the balance sheet is the total assets and revenue for the profit and loss statement. For example, if the total value of sales or income is 200 ringgit and the profit is 100 ringgit, the profit is reported as 50% and the sales are recorded as 100%. It depicts the relationship between individual elements and the base elements. The benefit is 50% of the sales in this case according to the relationship.
Assalamualaikum, my name is Muhammad Airi Iqbal bin Ismail, PDA 1905037. So next we proceed to accounting ratio and ratio analysis. The first one is liquidity ratio. Purpose of liquidity ratio is to determine the ability to cover short-term obligation. The higher the ratio is, the more likely a company to pay its short-term bill. Second purpose is determine creditworthiness. Creditor will analyze ratio to decide whether they should not extend credit to a company. So this is the calculation for liquidity ratio. There is three types of ratio, which is net working capital, current ratio, and quick ratio. The first one is net working capital. Current asset minus current liability. Net working capital is to reveal whether a business has an efficient amount of net fund available in the short term, which Ajinomoto Berhad is more higher net working capital than Asia 5 Corporation Berhad. Net is current ratio. Current ratio is current asset divided by current liability. Ajinomoto has 6.71 times more current asset than liabilities to cover its debt, while Asia 5 Corporation Berhad 5.47 times to cover its debt. The last one is quick ratio. Current asset minus inventory divided by current liability. Ajinomoto Berhad are better than Asia 5 Corporation Berhad in company short-term liquidity. For second ratio is asset management ratio. Purpose of asset management ratio is to indicate how successfully a company is utilizing its asset to generate revenues. Analysis of asset management ratio tell how efficiently and effectively a company is using its asset in the generation of revenues. Asset management ratio indicate the ability of a company to change its asset into the sale. There is four types for asset management ratio, which is inventory turnover, days sale outstanding, non-current assets turnover, and total asset turnover. For inventory turnover, sale divided by inventory. Ajinomoto Berhad has sold and replaced inventory in 10.03 times. Then Asia 5 Corporation Berhad with 3 times. So Ajinomoto Berhad is more better than Asia File Corporation Berhad. Net is day sale outstanding, receivable divided by sale times 365 days. Ajinomoto takes for 86 days to receive payment, and Asia File Corporation Berhad takes time 76 days. So Asia File Corporation Berhad is better. The third one is non-current asset turnover, sales divided by net non-current asset. Non-current asset turnover is to determine the efficiency which a business use its non-current asset to generate revenue. So Asia File Corporation Berhad is more better. And the last one is total asset turnover, sale divided by total asset. Total asset turnover is to measure the efficiency of a company asset in generating sale revenue. So Asia File Corporation Berhad is more better than Ajinomoto Berhad. The third ratio is debt management ratio. The purpose of debt management ratio is to measure the firm's ability to repay long-term debt. It is a financial ratio that indicates the percentage of a company asset are provided via debt. The higher the ratio, the greater risk will be associated with the firm's operation. So for the debt management ratio, there is four types of ratio: equity ratio, debt ratio, debt to equity ratio, and times interest earned. So the first one is equity ratio, shareholder equity divided by total asset. Equity ratio is mean how much a company asset has been generated by issuing equity share then taking on debt. So Ajinomoto Malaysia Berhad is better because the lower the equity ratio, the more debts a company has used to pay for its asset. Second is debt ratio, total liability divided by total asset. So for debt ratio, Asia File Corporation Berhad is better with the lower debt ratio than Ajinomoto Malaysia Berhad, because the higher debt ratio make company more difficult to get to borrow money. The third is debt to equity ratio. Long-term debt equal divide by total equity. Debt to equity ratio is to indicate the relative proportion of shareholder equity used to finance a company asset. So Asia File Corporation Berhad is more better with lower ratio, with lower risk. The last one is time interest ratio. Earning before interest or tax divided by interest expenses. Time interest earning a measure of a company ability to meet its debt obligation based on its current income. So Asia File Corporation Berhad is better with higher ratio, with 57.74 times, then Ajinomoto Malaysia Berhad with 4.52 times, but both are considered an acceptable risk.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. My name is Karunaim Aji bin Siswoko, PDA 1905032 from class DIA CP. In my part, I will continue from the previous presenter that will present about the profitability ratio. The purpose of profitability ratio is used to evaluate a company's ability to generate revenue over a period of time, as well as its expenses and other costs related to revenue generation. Then the ratio represents the company bottom line. This is the calculation for the both company for the Asia File Corporation Berhad and also the Ajinomoto Berhad. Next is market value ratio. The purpose of market value ratio is help to assess the economic condition of listed companies and plays a role in identifying stock that may be overvalued, undervalued, or reasonably priced. So it's the calculation for the both company for the earning per share. Next is comparison and analysis for the ratio that we have calculated before. So the first one for the liquidity ratio, we can show for the net working capital is it show that Ajinomoto Berhad has a better performance than Asia File Corporation Berhad when Ajinomoto Berhad gain more profit than Asia File Corporation Berhad. This is because Ajinomoto Berhad has better management in its inventory and its account receivable than Asia File Corporation Berhad. For the current ratio, Ajinomoto Berhad has a better ratio than Asia File Corporation Berhad. This happened because Ajinomoto Berhad demonstrate more of their business ability to generate money to meet its short-term obligation. Asia File Corporation Berhad obtained a small current ratio that may be due to an increase in short-term debt or a decrease in current asset. Then for the quick ratio, in terms of quick ratio, Ajinomoto Berhad have a better performance ratio than Asia File Corporation Berhad. This is because Asia File Corporation Berhad has lower sales and inventory turnover than Ajinomoto Berhad. It can be improved through converting inventory to cash or account receivable. Okay, so next for the debt management ratio, we can see that for the equity ratio, Asia File Corporation Berhad has better performance compared to Ajinomoto Berhad in equity ratio that represent the proportion of shareholder equity to total asset. Asia File Corporation Berhad is said to perform better because a higher ratio indicates that shareholders have provided significantly enough fund to purchase the company asset rather than relying on other sources of funding. For the debt ratio, Asia File Corporation Berhad has better performance in debt ratio compared to Ajinomoto Berhad. This is because the debt ratio shows how risky it is for a debt financing provider to lend a loan to a company. So if Ajinomoto Berhad has a lower ratio, it means the company is less risky than Asia File Corporation Berhad, which has a higher ratio. For the debt to equity ratio, Asia File Corporation Berhad has a lower ratio, which means those company has a better debt to equity ratio compared to Ajinomoto Berhad. The debt to equity ratio indicates how much a firm relies on debt to finance its operation rather than only on funds. For the time interest earned ratio, Asia File Corporation Berhad has a better interest earned ratio compared to Ajinomoto Berhad. The time interest earned ratio is used to determine a company ability to pay for the interest costs. Next, for the profitability ratio, for the net profit margin, Asia File Corporation Berhad has better performance than Ajinomoto Berhad because it measures the amount of net profit a company obtains per dollar of revenue gained by Asia File Corporation Berhad is higher than Ajinomoto Berhad. For the gross profit margin, Asia File Corporation Berhad has a good performance than Ajinomoto Berhad. It reflects how successful Asia File Corporation executive management team is in generating revenue. For the return on asset, Ajinomoto Berhad show better performance than Asia File Corporation Berhad because it show how efficient Ajinomoto Berhad management is in generating earning from their asset. Next, for the return on equity, Ajinomoto Berhad has a better performance than Asia File Corporation Berhad. It shows that Ajinomoto Berhad has better ability to turn equity investment into profit. The last one for the comparison is about the market value ratio. We can see that Ajinomoto Berhad show good performance than Asia File Corporation Berhad. because if investors think a company's profit are higher than its share price, they will pay more for its stock. I think that all from me, from my part. Thank you.
So today I will be explaining or presenting the comparison analysis industry for Ajinomoto Berhad and also the Ashafa Corp's Berhad. Okay, the first one we will go to the comparison analysis industry for the quick ratio for the both company. First of all, the Ajinomoto Berhad 6.71, Ashafa Corporation Berhad 5.47, and which is for the ratio for the industry is 0.29. So we can see here both of this company have a higher ratio compared to the industrial ratio, which indicates that both company have ability to pay all of their outstanding liabilities by selling their assets, because in quick ratio it indicates how good they are in paying liabilities and how good their assets can be converted to cash. So both of these company have a very good ratio, and we can see Ajinomoto is slightly higher than Ashafa Corporation. The next one is the asset turnover, so which indicates how good this company use the asset to generate sales. As we can see here, the industrial ratio is 0.03, and both of these companies have higher ratio compared to the industry. And we can see here also this time Ajinomoto have higher ratio compared to Ashafa Corporation, which is 0.084 and 0.048 respectively. Also, next, the third comparison is the inventory turnover. So, which is means how good their sales are, or how much they have to replace their inventory or restock their inventory, because the inventory have been sold. Okay. So the first one we look at the industrial ratio, which is 3.4. And we can see here on the left, Ajinomoto Berhad is 10.03, whereas Ashafa Corporation is 3. We can see here that Ajinomoto Berhad is doing very well, which is higher than industrial ratio. But for the Ashafa Corp, it's only 3, which is lower than industrial ratio, which means that the sales was not really good in terms of the rate of inventory being replaced after being sold out. And the last one is current ratio. So this one is it indicates the ability of the company to pay their debts or liabilities, the short term one, within 1 year or less. You can see the industrial ratio is 1.39, and you can see here both of the company have higher ratio compared to industrial ratio, but this time also Ajinomoto have slightly higher ratio compared to the Ashafa Corporation. So based on all of these comparison, we can say that the Ajinomoto Berhad is doing better or greater than Ashafa Corporation, because Ajinomoto Berhad have higher ratio in all of these analysis. Next one is the cash flow analysis. You're going to see the first one is net cash flow from operating activities, which shows the company's performance of its main market or activities. So you can see here Ajinomoto Berhad have 65 million in comparison to Ashafa Corp's Berhad, which is only 31 million. So we can see here Ajinomoto Berhad have a stronger operation in comparison to Ashafa Corp Berhad. So next is net cash from investing activities. We can see here that Ajinomoto Berhad is not really doing really good, because they have a deficit of 58 million, as a negative 58 million, in comparison to Ashafa Corp, which have 62 million. So this shows that Ashafai Corp Berhad is doing a better job at allocating cash for long-term investment and has provided more cash flow from investment activities compared to Ajinomoto Berhad. So, and the last one will be the net cash flow from financing activities. So we can see here both of the company have a negative value, or negative net cash flow from financing activities. But so we're going to, but in comparison for these two companies, we can see that Ajinomoto Berhad is doing slightly better compared to the Ashafai Corporation. So which indicates that Ajinomoto Berhad have a stronger financial strength and a better structure of capital and how the capital is being handled. Okay, I think that's all. Thank you very much.
The last one is limitation of analytical and interpretative techniques. Ratio analysis is a recommended method of financial analysis, and it is a program that allows you to visual financial statement and extract data from them. It focuses on indicators that represent corporate profitability, productivity, leverage, and other key indicators. Both horizontal and vertical analysis are possible. Although ratio analysis is a common analysis method, it has some shortcomings that financial analysis should be aware of. Ratio analysis compare the data in the financial statement to get the overall situation of the company business, annual account, and cash flow. This research is particularly useful for outsiders, including credit analysis, lender, tender, and stock analysts. These people should be able to understand the company financial status and performance based solely on the company financial statement. There are several shortcomings on proportional analysis that need to be considered.